Hello. This is the first of three specialised topics where we apply the knowledge gained in topics 3 and 4 and earlier on, but particularly the technical knowledge that we've been going through in topics 3 and 4. And in this topic and the next two topics, we're going to be applying that knowledge to particular types of portfolio. So topic 5, this series of videos, is about fixed income portfolios. And there are only 4 sections here, but I'll still do 6 videos. I'm going to take the first topic quite slowly. I'm going to define the different types of portfolios and their risk factors. And then I'm going to be continuing to go through the technical process of mapping cash flows. Then general theory about value at risk for cash flow portfolios. And for a particular example, we're going to be looking at applying that theory to a gilts portfolio. In other words, a portfolio of UK government bonds. So let's start off with modelling the cash flow portfolios and their risk factors. Remind ourselves to begin with, what is interest rate risk? Well, in topic 1, we've already described different types of risk, and interest rate risk is market risk. So it's the uncertainty in the future value of an investment. And in the case of interest rate risk, the uncertainty arises from changes in interest rates. So the type of portfolio that has interest rate risk is a cash flow portfolio. Other types of portfolios like equity portfolios or commodity portfolios, they don't really have very much interest rate risk. The only such risk that they have is because they may have borrowed money to make the investment in shares or commodity futures. And so payments on the funding there, which will probably be tied to interest rates, there is some uncertainty in those payments, but it's typically rather small relative to the market risk that arises from the main risk factors for equity and commodity portfolios. So what is a cash flow portfolio? It's one that's fully represented. There's no residual risk, as we shall see where there is when we do the cash flow mapping for equity portfolios, for example. The cash flow portfolio is completely represented as a stream of future cash flows, which changes at each point in time. In a cash flow map, you have a line up at some term or maturity, which if it's up, it represents income at that time. And if the line goes down, then it represents a payment at that time. So these cash flows, whether positive or negative, have to be discounted to today to measure their risk. And that's where the interest risk comes. I mean, there could be other interest rate risk, depending on the size of the cash flow, if they're tied to floating interest rates. But all cash flows will have interest rate risk because of the changes in the discount rate that you use. So it's changes in discount rates that drive differences in present value, and the uncertainty in the present value of the cash flow is how we measure interest rate risk. So the cash flow representation will probably be different tomorrow because you've lost one day, so the terms or maturities shorten by one day. That's minor, really. But the major uncertainty can be sometimes discount rates can change quite a lot from day to day. So we need to recalculate interest rate risk daily. So which type of institution faces interest rate risk? Well, it affects most financial institutions, but in different ways depending on the type of products that they have on their books. Banks issue fixed and floating rate loans. And if you remember from topic 2, part 4, they prefer to issue floating rate loans because they use mark-to-market accounting. And so when they discount their future assets and liabilities to today, they are going to be using floating discount rates, often the same as, or there's just a constant credit spread between the discount rate and the payments or income that they get in the future if it's floating and linked to something like SONIA. I'll talk about that in a later video. So fixed rate loans definitely have interest rate risk for banks. That's why they don't like to make them. Floating rate loans have little or no interest rate risk, at least for banks. They do for corporations because corporations use cash accounting. So they're going to use a fixed curve to discount to today. So the main risk for banks is actually credit risk, is the default on the loans that they have issued. What about governments and corporations? Well, these tend to issue or purchase bills, notes and bonds. Remember, bills are the short ones, notes are the between about 18 months and 10 years, and bonds are like 10 to, well, in the US, you've got a 100-year bond. And these could be fixed or floating rates, and they're going to have interest rate risk. Then any participant in an interest rate swap, typically a bank and a corporation, because the corporation wants to swap their exposure to floating rates to an exposure to fixed rates, because that's not so risky for them under cash accounting. So both participants, there's always two of course, they faced interest rate risk because there are going to be changes in the forward interest rates that drive the payments in future on a interest rate swap. So let's have a look at the interest rate risk of fixed rate payments. Now, future fixed rate payments are known today. For example, the buyer of a 3-year fixed coupon bond, they're going to have to buy the bond today, that's the purchase that you see here. And then suppose the coupons are paid semi-annually, so you've got 6 payments over 3 years. So you receive a coupon every year until the last year, when you not only get the coupon, but you get the face value of the bond back. And of course, the issuer of such a bond would have a very similar cash flow, only it would be flipped so that the what is a down arrow here would be an up arrow for the issuer, and what is an up arrow would be a down arrow. So the reason for these types of cash flows having interest rate risk is that we look at the present value, and for the present value we use a discount curve as we see it today. And so we have to have discount rates of these 6 months, 1 year, 1.5 year, and so on. And so that's a whole curve of discount rates. And every time this curve changes, the present value changes. Even if just one of the discount rates changes, the present value will change. And what about interest rate risk of floating rate payments? So whether it's an interest rate swap, or indeed it could be a variable rate loan or a variable coupon bill, note or bond, all of these depend on what we call forward rates, or the whole curve, the forward rate curve. Whenever we're looking at our cash flow, the cash flow itself, not just the discount rates, but the actual amount of the payments or the income, is going to depend on that forward rate curve. So for example, here's a picture of the payments to each party in an interest rate swap. So remember, for a swap, we have some nominal amount, a notional amount. Sorry, I mean notional. So it doesn't really exist, it's just notional, but it's how we calculate the payments. $100 million does not exchange hands at all. It's only the payments are calculated relative to that notional amount. And above we have the fixed rate payments, they're the same all the time. And below we have the floating rate payments. Now, I think when I went through in topic 2 in detail, interest rate swaps, I explained that the swap rate is fixed beforehand. So the first payment you're going to know, say at half a year from now, or say 3 months from now, it says here. But then we'll have to recalculate the swap rate when we know the curve in the future. But at this point in time, we're going to take the SONIA curve. It used to be LIBOR, and this is an old diagram. And so we look at the SONIA rate at 3 months. And so it's the 6 month forward, 3 month SONIA. And here we have the 9 month forward, 3 months SONIA, and the 12 months forward, 3 months SONIA. Those are the forward rates. So each forward rate has a term or maturity and a tenor. The tenor is 3 months, but the term is, or maturity is 6 months, 9 months, 12 months here. And this forward rate curve is going to change daily. So the payments on the floating leg, and so when these change, then there's only a net exchange of cash flows, right? Depending on which is larger, one party pays the other. And so as long as the forward rates change, the cash flows for each party are going to change. So how do we calculate forward interest rates? What is a forward interest rate formally? Well, it has a maturity or term M and a tenor N, and usually measured in months. So FM sub M plus N is the N month interest rate starting in month M. Now, just for simplicity, otherwise these interest rates, forward rates, need to be multiplied, for example, by 0.25 because that's for the previous example, because we had 3 months of payments on the interest rate swap, or 0.5 if it was 6 month payments. Because remember, interest rates are always quoted in annualized terms. But that makes the formulae so complicated you can't see the wood for the trees. So I try to abstract from that, and I'm just going to be talking about how to calculate 1 year forward rates of tenor 1 year. And so we're going to denote those F sub TI, TI plus 1, and the years are going to be T1, T2, and so forth. So we can think of T1 being 1 year, T2 being 2 year, and so on. So we start with a spot rate curve, and that's how we're going to get the forward rates. So we're going to calculate them from this curve, R1, R2, Rn. For example, that could be the 1 year interest rate, 2 year interest rate, 3 year interest rate, but all quoted in annualized 1 year terms. The 1 year forward rate is derived from a simple relationship that if you compound your I year interest rate, Ri, the spot rate for TI years, so that's 1 plus Ri to the power TI, and then compound it further with 1 plus the forward rate, that has to be equal to the Ri plus 1, the next year interest rate, compounded to the power Ti plus 1. And so what we can do is we can take the right-hand side over to the left, and we divide 1 plus Ri. We take the 1 plus Ri over to the right-hand side, and we get this term here, 1 plus Ri plus 1 to the power Ti plus 1 divided by 1 plus Ri to the power Ti, but that is 1 plus the forward rate. So we take off 1 on the right-hand side, and that's our formula. So here's an example. Suppose we've got 1 year, 2 year and 3 year spot rates of 2%, 3% and 3.5%. Now, we could calculate 2 1-year forward rates from these data. Actually, we can get the 1-year forward rate 1 year from now, that's F12. And we can get the 1-year forward rate 2 years from now, that's F23. And then we use these formulae here for a different value of T. So Ti equals 1, 2 and 3. Starting with 1, we've got 1 plus the 2-year rate, 3%, to the power 2 divided by 1 plus the 1-year rate, 2% minus 1, which is 1.0609, because that's what you get over 2 years. That's the compounded 2-year rate. 3% is the annualized 2-year rate. 6.09 is the rate compounded over 2 years. Anyway, so the calculations give us 4%. Similarly, to get the 2-year forward 1-year rate, we take the 3-year, 3.5% compounded for 3 years, divided by the 2-year compounded for 2 years, and that gives 4.5%. Incidentally, we could also get a 2-year forward rate, and I didn't give you the formulae on the previous slide because I didn't want to make it too general, but it's pretty clear from this example that all we need to do is to divide the compounded 3-year rate by the 1-year rate, so not F23 but F13, which is 8.29%, and that gives a 2-year forward rate that you receive over 2 years, so it's a compounded rate now. Okay, so that's enough for this video, and I'll see you in the next one.